Okay, so this is part 2 of our lovely chapter 22 lecture. I'm looking at page 526, figure 6, very interesting figure. We see here our long run aggregate supply curve here, the blue vertical line, and a set of short run aggregate supply curves. Okay, so here, let me give you a little hint. A shortcut to reading the text, reading the figures, you can read the caption, but look at these steps. This is what really, when you get proficient at this, you can just read the steps. You start here, step 1. This is where our output and our inflation level are at an equilibrium level, okay? Very good. The first thing that happens, let's say there's an increase in inflation, or an increase in output. A positive output gap from 10 to 11, 11 minus 10. That will result in a movement along the curve, the AS1 curve. If then this gap is persistent, let's say it lasts 6 months or a year or more, what happens is this increase in inflation will result in an increase in expected inflation. Okay, here's our expected inflation coming into becoming a big factor. And a result, that increase in expected inflation results in a shift up of the aggregate supply curve to, say, AS2, and that will continue to occur as long as the output gap increases. Say it goes up to this level. As the output gap then decreases, we would move along this AS4 curve down to 0.4 there, okay? As the output gap persists, expected inflation increases and increases and increases until, so it would result in further shifts up until the output gap subsists, and then you'd move down your aggregate supply curve, okay? Very good. Very important to remember the effect of expected inflation. Okay. So Table 2 on page 527 summarizes the factors that would cause an upward shift in the supply curve. Okay. Expected inflation increasing, an inflation shock like oil price increase, or a persistent output gap. Okay. Okay, so now we're up to page 528, looking at figure 7, and what we've done here, we've taken one aggregate demand curve here and one aggregate supply curve, put them together, and we have an equilibrium point at a certain output level and a certain inflation rate. Okay? So this is in the short run. Okay? So now we're going to, at this point, we're going to really start to do our work here and see how these curves shift and how that affects equilibrium, output, and inflation. Okay. So here we are on page 530, figure 8, and we're going to examine what would happen if initially we were here at an equilibrium output level, which is at a level of output which is greater than the full potential output. Okay, so what would be the situation here? If we were at this point, we're greater than full potential output, we would have tightness in the labor market. Tightness in labor market. Okay? That would cause expected inflation to increase. Okay? We saw that an increase in expected inflation would result in the AS curve increasing, right? That would continue. Still, what's happening here is at this point here, the increase in inflation we know that that's going to, on the demand side, that's going to result in the Federal Reserve to raise real interest rates. That's going to result in a fall in investment and a fall in output demanded on the demand side, okay? But assuming here that at this intermediate level, output is still greater than potential output here, so that would cause further, still more tightness in the labor market would still be prevalent and cause more expected inflation, resulting in a further shift up in the aggregates short-run supply curve until we reach a point here where output, we have an equilibrium in the demand and short-run supply curve, where we're at now the full output, the full potential output level, and so there would be no tendency now for either curve to shift. Okay, the supply curve, we didn't have a shift in the demand curve, but at this point the supply curve would not have any reason to shift. Similarly, you could take the case here where if we were initially, for some reason, at an output level less than potential level here, we would here be at an equilibrium here, and there would be slack in the labor market, which would cause an expectation of a lower level of inflation. So inflationary expectations would be reduced. That causes a shift down in the short-run aggregate supply curve. We'd have an equilibrium here. The demand curve hasn't changed, hasn't shifted, but we're still at lower than potential output. So we'd have still further fall in expected inflation, further shift in the short-run aggregate supply curve until we reach this level here, where we're at the output level is at potential output level. There's no slack in the labor market, and we're at an equilibrium, okay? So that covers the case where either we're initially at higher or lower than potential output, okay? Okay, so now we're going to look at shocks on the demand side, okay? So here we are at our initial point. Again, look at your, when you study this stuff, look at your steps. Step one, we're at this point here initially. Look at the points are labeled. 1, this is where you start out with. Then you read step 1 here, which tells you what happens first. Step 1, aggregate demand shifts to the right. Okay? There's a positive shock to aggregate demand. Okay? A number of things could happen. For example, autonomous consumption. People decide to spend more. Not dependent on their income, okay? Or taxes, government spending can increase. Taxes could decrease. A number of things, okay? Exports might increase, okay? A number of various things. Aggregate demand, these autonomous factors increase, so they don't depend on inflation changing. So the whole demand curve shifts to the right, all right? Results in a temporary equilibrium. Remember, we're on the intersection of our long-run aggregate supply and our short-run aggregate supply. The new equilibrium would be here. New demand curve, original supply curve. We have now output greater than potential. As we saw before, when that occurs, we have an increase in inflationary expectations, causes a shift up in the aggregate supply curve, okay? That's step 2. Step 2 is going from 1 to 2 along the original supply curve. Step 3 is the shifting up of the supply curve due to increase in inflationary expectations. And step 4, the economy now returns to equilibrium at potential output. And notice what happens here. This increase in demand, when you're at equilibrium, long-run equilibrium, let's say, your output, you have an increase in demand, but because in the long run you can't produce more than your potential output, so the intermediate increase in output is backs off and reduced to long run potential output. But look what happens. That increase in demand has resulted in a higher inflation rate, okay, which is not good. So we're going to see later how what the government can do in order to rectify that. Okay. Let's go here. Let's do a click with the mouse. So that was, we saw what happened. Aggregate demand increased. We saw we got an equilibrium. So here we are at this point now with, say, a higher inflation rate than we would want. We're at potential output here. We have higher inflation than we want. This occurred back in 1980 when Paul Volcker was chairman of the Federal Reserve Board. I'm sure none of you were alive, of course. This is when I was in graduate school. And I started working at Citibank and the bond division. Everybody was up in arms about inflation. One of the big innovations in the financial markets occurred at that time. Before people put their money in the bank and savings account, they were earning these paltry rate of interest. Maybe today it seems like a lot. Back then it was like 5%, 4%. All of a sudden there's an innovation now where these money market accounts were created where individuals could start, they go to Fidelity or Dreyfus, Schwab, and be able to invest in these savings accounts. And banks had them too. Savings accounts. I don't know if banks had them. They had certificates of deposit, but these brokerages had money market accounts which were invested in short-term treasury bills, or treasury bills are short-term, treasury bills, commercial paper, etc. And individuals were able to take out small accounts, for $1,000 minimum and start earning 10% interest. It was a huge innovation. Anyway, we had inflation then of, as it says in the book there, 1980, 13.5%. If you can imagine, 13.5%. Today, inflation is 1 or 2%. Okay, you can imagine 13.5% every year. You go to every month you go to the grocery store, prices were increasing, and as I said before, it doesn't occur. Everything doesn't shift up at the same time. Different things increase in price at different times. In the meantime, your wages are lagging behind. became a very chaotic situation. So the Federal Reserve Board was tasked with solving this. So here we are, monetary policy. We're starting here. Step one, tightening monetary policy, okay? Here's our initial equilibrium in the federal funds market. Tightening monetary policy. It's going to result in the shift to the left, reduction in the monetary base, sell bonds. The Fed's going to sell bonds or bills, treasury bills. Bonds go to the public. Money goes out of the public space, right? Reserves fall. The nominal rate, remember the federal funds rate is a nominal rate, okay? But that's okay because we know that the nominal rate equals the real rate plus the inflation rate, right? As you reduce the nominal rate for any given, well, this could be the expected inflation rate, right, as a behavioral equation. For any given expected rate of inflation, that causes the real rate to fall. As the real rate falls, that causes investment to fall, okay? So, which causes income to fall, all right? So at any given inflation rate here on the original demand curve, we would expect a fall in output. At any inflation rate, we would have a fall in output. So tightening causes our demand curve to shift here to AD2. We went from AD1 to AD2, okay? So now we're from point 1 here to point 2. Notice aggregate demand has fallen. Our intermediate equilibrium here now, as you know, you might expect from the sound of it, output, demand falls, output falls, and inflation falls, okay? But what about this point? It's below potential output. As we saw before, that's going to cause our supply curve to shift to the right because, or shift down because we're below potential output. So wages are not going to rise as high as they were. People are not going to expect inflation to be as high as it was. You're going to have a fall or a shift to the right of the aggregate supply curve, resulting in a new equilibrium at point 3, okay? So we've gone from here down to here. We've ended up at the same output level, but we've corrected our inflation problem, all right? Very good. And if you look at the bottom, whoops, can I move this up? If you look at the little table down here at the bottom of figure 10, this is starting in 1980. We had sort of full employment or reasonable unemployment. We had high inflation. Volcker came in, shifted the aggregate demand curve to the left, resulting in initially increasing unemployment, as we saw here. We saw that inflation dramatically fell from 13 down to 10, down to 3. And then as the supply curve shifted to the right, and unemployment fell, or output increased. Same thing, unemployment fell, more people were working, employment increased, and inflation fell further. Look at that, it's beautiful how it's a textbook example, it's in the textbook, of how monetary policy was able to solve our inflation problem there, okay? Let's hear it for economists, okay? They did a good job that time. Okay, so let's take a look at the case of another negative demand shock. Okay, this is a negative demand shock. The previous example was a shift in the demand curve negatively that was caused by the Federal Reserve. Now we're going to look at a shock, various events in the economy that caused aggregate demand to fall. This is between the 2000 to 2004 period. In 2000, leading up to 98, 99, 2000, we had the beginnings of the great tech bubble, okay? This was the beginning of internet companies. They were issuing stock. At that time, they didn't have revenue. All these stocks started to go up like crazy, and people were buying them like there was no tomorrow. And eventually, as with all bubbles, they're gonna burst. Not to overuse the analogy. So other things that were causing negative, so that would be the bursting of the bubble was a negative demand shock. September 11th, 2001, you had the terrorist attack, weakened consumer and business demand, consumer and business confidence. In 2003, you had Enron going bankrupt, oil company. All these things were causing a negative demand shocks. So originally we were here at potential output. The demand curve shifts to the left. We move along our aggregate supply curve. Sort of a technical thing is the way this works on the graphs, and it's interesting that when one side of the market, one curve shifts, the effect is to then trace out the other curve in the data. If the aggregate supply curve remains constant and you have an autonomous shift in the demand curve, over time you're going to, in the data, you're going to see these points, okay? And that gives you a way of measuring or statistically discovering what the supply curve was. It's a little technical bit of information for you. So we arrive at here, point 2, the equilibrium of our shifted demand curve and original supply curve. Okay, and we know what's going to happen here. We're below potential output. Labor markets are going to be they're going to be slack, causing wage demands to be reduced and shifting down of our supply curve, and now our supply curve shifts down. Notice technically what that's going to do is going to trace out the new demand curve. So we're going to end up at potential output again, but the negative demand shock has resulted in a fall in the equilibrium inflation rate, which is not a bad thing, but look at the cost of getting that. It was years of higher unemployment, from 1 to 2 to 3. All that time, there was greater than normal unemployment. It was a very unsettling time in the United States, okay? 2000 to 2004. And, it's a little cut off here, but so we can sort of see this in the data, although it's not as clear-cut as the previous case. 2003, 2004. Whoops. The shift down of the demand curve caused output to fall, which if output is falling, that means the unemployment rate would be increasing, and so we see here higher unemployment, and we saw inflation decreasing. And when you have now our shift of the supply curve, finally unemployment starts falling, output starts increasing. Of course, unlike the graph up here, theoretically we would expect inflation to keep falling here. It didn't in the data. You remember, there could be other causes of inflation, okay? So we have this model hasn't taken into account other causes of inflation. So that's why you have to look for why these data points don't match up with the simple model we have up here. Okay.